the rest of the slides. And welcome, oh, I didn't start the recording. Welcome Monday, February 24th. I believe this is session number 8. And the agenda tonight is we're going to do Unit 7 till about approximately slide 60. Wednesday we're going to be reviewing the midterm, finish Unit 7. And then if we have time, we're going to do a Social Security overview. And then next Monday, we will be working on Unit 8. So since you didn't get to see what I was working off of, I'm going to get rid of this. Now, if you remember, last Wednesday, I went through an overview of life insurance. And I called it Life Insurance and Annuities 101. And I hope that helped you as you were going through the material in the textbook, and I definitely hope it helps you tonight understand what you need to understand regarding life insurance. I will tell you I'm a huge believer in life insurance as a risk management tool for families. I'm a huge believer in it because I've been on the side of the table in the real world where I've had to deliver, or I've been able to deliver a death claim check to a family that has permitted us to keep the family in their world. And I've also been on the side of the table where I wasn't able to do that. And in one case, a grandfather who was about to retire didn't retire because he was helping to support his daughter and 3 grandchildren because son-in-law in his mid-30s, I think he was 34, 35, 36, was a Little League coach or a soccer coach, came home one day, wasn't feeling well, went and laid down in his room and had a massive coronary. So things do happen. When we're talking about life insurance as a risk management tool, and I'm not discussing this as whether you think whole life is the best product, term insurance is the best product, it doesn't matter. I'm talking as what is needed as a risk management tool, and that's the approach I'm taking tonight. I also believe that as a financial planner, as a financial advisor, I have a responsibility to people and their families to bring up what I think is important. And I do let people know in advance that I have a bias or I have a feeling about this. And, you know, I said, it's going to be in your plan. That doesn't mean you have to necessarily implement it, but it's probably going to be a recommendation. And if it's not needed, you're going to know. The reason I believe that is, as I just said, I've been on the side of the table where I've been able to deliver a check from an insurance company. I've also been there where I was not able to deliver the check. But most importantly, I believe that I have to be an advocate for the family and the people that that my clients are going to be in 20 or 30 or 40 years, as well as for the people that aren't at the table, such as sometimes a spouse, children, extended family, business partners, even employees, who are most impacted by the decisions we all make. And nobody wants to talk about life insurance at all because no one wants to talk about dying. That's why insurance companies don't call it a death benefit, they call it a face amount. But death is part of life, and as I think I said, there's no guarantee that someone isn't going to prematurely die as an infant or at the age of 5 or 10 or 20 or 25. If you think about not just what you hear on the news, but maybe think about what you've heard in your own lifetime from different people about loved ones that have died at a young age. And it's always tragic when children die. It's always tragic when young parents die. It's even somewhat tragic when somebody who's 90 years old and was vibrant and had people that love them die. So I'm not referring to just a tragedy. I'm referring to the economic loss that can be felt. And that's what we're talking about. Life insurance provides dollars for future delivery at a discount today. That's called the premium. Now that's not on your exam, but that's what it really is. It's dollars for delivery in the future today at a discount. And life insurance gives people the ability to plan for the incomes they're not going to be able to generate on their own. Now, when we're talking about risk exposure related to death, the planner and the client will work together to identify what amount of risk we need and how much exposure we have. Now think about your own life for a minute, especially if you're married and have children. And I don't care if you're working outside of the home or if you're not working outside of the home, but think about where you're at and how much debt is involved. Your mortgage, your car payment, a student loan. Yes, student loans are forgiven if it's part of the FAFSA program that you filled out. The loan itself is going to be forgiven when you die, but what about the spouse's loan? What about your final expenses? Today in the Chicago metropolitan area, it's not uncommon for funerals to be in excess of $10,000. And that's not a fancy funeral. And sometimes you have to allow for helping other family members that you want at the funeral come in from out of town if they can't afford it and you really want them there. And sometimes the final expenses and the medical bills become huge and overwhelming. So we're talking about providing dollars. So if we're talking about the loss, the economic loss, number one, let's think about how much debt there is. Mortgages, car loans, credit card debt, maybe medical payments, other debt, student loans of the a spouse who passed away, the non-spouse who passed away. Think about other expenses. Some people go to parochial schools, private schools, housing, food, and yes, Social Security is going to pay a portion of that for most people, but it's not going to pay all of that. And you don't have the privilege of calling your mortgage company or the county tax collector and say, well, Jack or Jill passed away, so we only have 4 people living in our home, not 5. Can we get a 20% discount on our mortgage or our property tax? It's not going to happen. I believe that regardless of the situation, when anybody passes away, there is some kind of an economic loss. When a wage earner passes away, as I just said, final expenses in the Chicago area are approximately $10,000. You have your mortgage, income for the survivors, education fund, the adjustment fund. The first time I had to deliver a death claim as a financial, actually at that time I was only in the insurance industry, but the first time I had to deliver a death claim, ladies and gentlemen, it was to a 5-year-old's family. And let me set the stage. I had a client who called me up and said that there was a life insurance policy that an uncle had purchased on his son. And when the son was a newborn. And the life insurance policy was for, I think it was $2,500. And the uncle had prepaid for the first 4 or 5 years. And the child, and after the 5th year, there was a benefit that kicked in called accidental death, which meant that $2,500 doubled. At age 18 or 20 or 21, you could increase it 10 times by paying X amount of dollars at that point. And the little boy was killed in an accident the week after he turned 5 years old, and about 3 weeks after the parents had paid the premium for age 5. So here we are with an insurance company that had paid a premium for, or accepted a premium for this policy, and the little boy died in an accident, a tragic accident. But then again, I think anytime a little child dies at the age of 5 in an accident, it's obviously tragic, so let's not be redundant. And they used that money to take their other children to Disney World. And I remember the father calling me up and asking me if he was being frivolous because the grandparents had said, we're going to pay for the funeral. So they paid for the funeral, they had this money, and they went away for 2 weeks with their other children to rebuild their lives and try to get some semblance of order before school started. Now, nothing would replace the child, but that was highlighting to me the importance of an adjustment fund on what people use it for. And I've seen something like that several times in my career, not just for children, but when mom or dad pass away, especially after a lengthy illness. Sometimes you have to worry about federal, state, or other state taxes, and sometimes you have special situations where people care for siblings or parents or other special needs children. All of these are issues that have to be considered when the wage earner dies, and in our society today, most families have two wage earners. So in many cases, when you're doing a financial analysis for insurance, you take Jack's, you take Jill's income. I ask the question frequently, is when I'm doing the plan and doing my fact-finding situation, I will ask the question, what do you want to have happen if you have student loans outstanding? Do you want the ability to have all of the loans paid off if something happens to one of you? And then I really have to explain in almost every situation that the loan of the deceased, if it was through the federal program, is forgiven, not because the federal program is benevolent, but because the federal student loan program has it built into the program that there's an insurance policy to cancel the loan at death. Now, I submit dying is a rather drastic way to have your student loan canceled. But the question is, do you want to have the spouse's loan canceled? And I ask all these questions, and I use all of this as an opportunity to explain things to people. Even though more and more families have two working spouses, you still have to worry about what happens to the non-working spouse. If somebody passes away, do you have child care? Do you need a nanny? How much is that going to cost? Especially if there's more than one child. What about other household services? Cooking, cleaning, chauffeuring. What about parental care or unique situations? All of these have to be added into the numbers you have to consider when you're dealing with life insurance as a planning tool for risk management. Now, I think I mentioned earlier that there are times, and I'm going to try, you don't get to see it, I'm sorry. There are times when in the textbook, the Vaughan book, it mentions human life value. I have to be very specific here. Human life value, sometimes you do HLV, says, what are you worth as a money machine? A money machine. You think of yourself as a machine that creates dollars. When do you create the dollars? During your working life, not during your entire life and not during your retirement. So if you get a test question that says Jack or Jill was making $50,000 a year, and in terms of their human life value, what would that be, assuming they retired at age 60, they were 30 years old, they retired at age 67, and they died at age 94. One of the answers given on the exam might be 50,000 times some discount factor or inflation factor, because it might even say, assuming you got a 3% increase, whatever. So it would be 50,000 times that. And one answer might go all the way from age 30 to age 94, but the real answer is to your retirement. And it might say to your full retirement age for Social Security, or it might say that Jack is going to retire at age 70. They're going to tell you what that retirement will be. But that is your human life value. It's as a money machine during your working years, not your entire lifetime. Human needs or needs analysis says we're going to turn around and figure out different needs you have and determine how to work that out. So I'm now on slide 6. Human life value method determine the appropriate amount of life insurance based on determining the present value of your income loss when the wage earner dies. You're not going to worry about your other resources or other insurance. You're not going to worry about other sources of income. It's only your earning potential for you during your working life. And I believe there's one of the large insurance companies talks about this in their advertisements of human life value, and then will also mention that human life value says maybe we're going to take off 15% for your own value, 15%, because if you're not here, you're not going to need a second car, you're not going to need your clothes and stuff, so they're going to take that off your spending money. But sometimes they just say, what do you make? Minus 30% for taxes, or what do you make? They'll tell you what you need to compute in the question. If they're saying just a value of your income, fine. If they're asking for the value of your net income, they'll tell you how much to take off. I want to make sure you understand how this is computed using it's in the Vaughan book. So if there's anybody who has a question, feel free to raise your hand or give me a check mark, but they'll sort of tell you. Focus on your working years, not on your entire lifetime. Needs analysis says and sometimes this is referred to as capital needs analysis, where it's going to say, we're going to figure out how much life insurance you need based upon certain predetermined categories. Final expenses, income needs, pre-retirement and post-retirement for the spouse, income needs for your children until they are age 18. What do you need for debt? Last final expenses, an opportunity fund, an emergency fund, special situations. And in this needs analysis, they're going to include your current insurance, they're going to include what Social Security is going to pay, and it's going to come back and say we need X amount of dollars of capital. Now, if you remember earlier in the semester, ladies and gentlemen, I spoke about capital in a very specific way for insurance, and I said you can be sitting with somebody in 3 minutes on the back of a napkin having dinner, you can determine what their debt is and do a capitalization of a number and have a rough idea if they're earning 3% or 5%, how much capital you need in terms of life insurance, add in the debt, and that'll give you a number. If we're talking of human life value, it's going to be pretty close to the same number, just figured out a little differently, and needs analysis will also be somewhat close. Capitalization does not spend down the principal. Human life value does not worry about anything other than your earning potential. Needs analysis will be spending down principal and Social Security and other benefits. The next slide, number 8, asks, why do single people need life insurance? Well, let's discuss that. Is it conceivable that single people might have to care for other loved ones? Is it conceivable that single people might want to leave a legacy to a school or a charity or something? It's also conceivable that while people are healthy, they want to buy life insurance because at some point they may be fearful that they may not be healthy, therefore they won't be able to buy life insurance. It's also conceivable that they may just want to leave a legacy to their parents, siblings, nieces, nephews. Or there may be special situation, children or other relatives they want to care for. I personally believe that most people need life insurance over and above what they get from work. That's a bias I have, and I will tell people up front when we talk about insurance, I have certain biases and the reason, and then I explain why. Now, the fact is, I'm open and above board about it. I explain it as part of the financial planning process, so I don't have any problem handling it that way. And I also will tell them, as I said to you earlier, that I firmly believe that I have to be an advocate for the people that aren't at the table. Now, I'm flipping over to slide number 10. If anybody has questions, I want you to take a few minutes and ask me. If you remember, last Wednesday, I spoke about the 1 cent plan. That meant that for every unit of insurance, it was going to cost you a penny to acquire it. I further said that this is temporary in nature, and that it was like having a box of protection, and that box of protection would then give you the opportunity to get a death benefit in the event that, I don't know why this is yellow. I really can't see yellow very well. But the box of protection would give you the ability to get a death benefit. You're not going to build any cash or any equity there, but you're going to have the ability to have a benefit should you need it. That benefit is called the face amount or the death premium or death benefit. Just like auto insurance or renter's insurance, if you don't need it, all you have is a receipt. Term insurance determines what is your current mortality or your life expectancy. The younger you are, the cheaper it's going to be. The older you are, the more expensive it's going to be. Therefore, in your 20s, 30s, and 40s, it's not very expensive. In your 80s, it's going to be a lot more expensive because it's using current mortality. You normally can buy the most amount of protection for the least amount of premium dollars using term insurance. Now, there are different kinds of term insurance contracts. 1-year term, 5-year term, 10, 20, even 30-year term. The longer we go out on that term continuum, in other words, the more risk we transfer to the insurance company, the greater the premium. When we talk about transferring the risk, you want to make sure you transfer as much risk as you can, which is why you want to make sure you don't need a new physical every couple of years, because when you need a new physical every couple of years, you're not sending to the insurance company as much, transferring as much risk as you can otherwise. Annual renewable term, sometimes referred to as yearly renewable term, says the premium is going to go up a little bit every single year. So between age 25 and 26, or 35 and 36, the premium doesn't go up very much. But between age 54 and 55, or 59 and 60, or 60 or 65 to 70, it's going to go up substantially because we are getting closer and closer to what's called full mortality. Full mortality is classified as age 100. Now, many years ago, most people didn't live to age 100. Today, the fastest growing segment of the population are people over the age of 85, and I think I said last session that if you look at what's going on today, there are more people alive today at age 65. Right now, on the face of the earth, more people at age 65 are alive today than were alive in the entire history of humankind since the beginning of time. So we have more people who are older worldwide. And out of that subset of people over the age of 65, the fastest growing segment of the population are people over the age of 85. Now, if you think about in your own lifetime how many people you know that are older, and how many people are maybe in their 90s, and you might even know some people at age 100 or close to it, it's a lot. In one of my live classes recently, I had 11 or 12 students, and 2 of them knew people over the age of 100. A third one knew someone who passed away at 106. So people are living longer, and that's also one of the problems we have to face with Social Security. Now, going back to slide number 10, annual renewable term says each year the premium can go up a little bit, and we're going to use current mortality. This permits the insured to have coverage with no evidence of additional insurability or taking a new exam. When you buy insurance, you really want to avoid the need to take a new exam every year, because then you're not transferring the risk to the insurance company. You're keeping a lot of the risk because your health can change. Premiums are going to rise a little bit every year, and usually the maximum age for renewal is probably somewhere around age 65 to 70. Level term insurance will be purchased, as I said, for 5 years, 10, 20, 25, or maybe all the way up to 30 years. The longer the guarantee, the higher the premium, because there's more risk to the insurance company that something might happen. Most people that buy term insurance, they end up not worrying about a death claim, but the insurance companies don't worry about the death claim either, because in all practicality, most people don't die with term insurance. Term insurance has become a commodity. How many of you go online and go to Google and say, inexpensive term insurance? You can find 19 websites. As a matter of fact, I one time tried this, and I had under 3 different brands or 4 different brands, I had like 5 different websites. I was using the same search engine, and I had people that would go to several of the same websites, figuring that if they went to enough, they'd be able to get different companies. And there's really only so many companies that do a really great job in term. Some people buy what's called re-entry term, which means, I'm on slide 12. Some people buy re-entry term, which means that every so many years, every 3 years or 5 years or maybe every 10 years, they have to re-enter and take a new qualifying exam. So if your health declined during that period, it's going to cost you more, or they may cancel the coverage. That means you're not really transferring as much risk to the insurance company as you should. And my belief is when you buy insurance, you want to transfer as much risk as you possibly can to the insurance company. So you want to buy term insurance with as long a period of a guarantee as possible that you can afford, and you also want to make sure the term insurance is level, the death benefit's level, the premium is guaranteed for that term of time, you don't have to take another exam. And you want to make sure it's convertible. And when we talk about convertible term insurance means it's convertible to a permanent plan of insurance that the company sells at the time you want to convert. It doesn't necessarily, it just is whatever is their permanent plan at the same premium classification that you purchased on the term insurance. Now, sometimes you can't do that because sometimes the insurance company has super duper duper preferred and then super preferred and then preferred plus and then preferred, but they may only have one category of preferred for whole life or universal life. So be aware that you still get preferred, but it may not be the super duper preferred that they have for the term. For the last so many years, term insurance has been very competitive. I think I said last week when I started in the insurance industry, a 5-year renewable convertible term was $5. I think it was 62 cents per thousand for a 35-year-old male who was preferred. Today, a 35-year-old male who's preferred is probably spending about 78 to 82 cents per thousand for a 20-year level term that's also convertible. So, again, term insurance is temporary in nature. About 95% of all term policies never pay a death claim. People shop it and change it frequently. The premiums are set up that way that it's not going to pay a death claim. The older you get with term insurance, the more expensive it's going to be because you're using current mortality charges for premium. The longer you go out on the term insurance grid, 10 years is more expensive than 5, 20 years is more expensive than 10, and you don't want to have to take a new exam. Now, sometimes there's a policy called decreasing term. Decreasing term says that we are going to lower the death benefit by some amortization schedule. It could be your mortgage schedule, or it could just be a yearly schedule. We're going to lower the death benefit, but we're going to keep the premium the same. And historically, this is used for debt, such as mortgages. I don't believe a lot in decreasing term because I believe it gives people a false sense of security, and here's why. Let's assume for a minute that Jack buys a $250,000 or $350,000 decreasing term contract that says it's going to decrease over a 25-year period for your mortgage. And Jack dies 15 years into the plan. That $250,000 may provide about $100,000 of death benefit at that point. However, even though the mortgage is paid, the family still has to worry about paying what? Property taxes, utilities, other upkeep. But there's a false sense of security because people believe that because you had that $250,000 term, that's what the death benefit is. They forget it's decreasing. So again, please be aware that you have to be very specific so people understand what they're getting. Welcome, Tom. I see another Tom just joined the class. So be aware of that. I'm not a great believer in it, especially since the cost of 20-year term is so inexpensive today. Most people don't need mortgage cancellation. I don't think you're going to get a test question on return of premium term. Return of premium term says if you live, we're going to give you back all your premiums. What you will have lost is the use of your money and the interest. But we're going to give you back all of your premiums. And let's assume your premiums were $600 a year, and you bought the policy when you were 30 years old, and at age 60, you get back all the premiums you paid. Well, if you live, you basically hedged your bet that you paid a little bit more for that term insurance than if you died, than you should have. If you died, you pay a little bit too much for the term insurance. Currently, there's no income tax on the benefit when received because it's just a return of the premium. There's no gain. It's just returning the premium. I don't think there'll be a test question on it, but I want you to be aware that it's now something in the market that you might be considering. I don't see any questions coming in, so I want to make sure if there are any questions, I allow for them. So if there are any, raise your hand or give me a check mark or something. In the textbook, and here on slide number 15, there is something that is called first to die life insurance, or joint life. What that says is we are going to underwrite 1 or 2 or maybe even 3 or 4 lives. And we're going to blend the premium between male, female, and we're going to blend the premium based upon age, and we're going to come up with an average. And then whoever is the first person to die, the insurance company is going to pay the death claim. Here's the problem. It's in the textbook, so I'm covering it. And one of your colleagues asked if there's a discrepancy between what the textbook says and what I say where to go. I have tried to find and have called many insurance companies over the last 5 to 7 years. And I've tried to find a company that still writes a first to die life insurance policy, and I have not been able to find one. But there are some out there. And the reason I haven't been able to find one is the cost of term insurance for most ages is so inexpensive that most companies say, well, it doesn't pay for us to continue to have a first to die when we weren't selling a lot, so we're going to stop issuing it because it's very expensive for us to keep policies in force. So first to die says we are going to pay the death benefit to the first member of the family that dies or to the first business partner that dies to help cover a loan or whatever. We're not going to cover on the second death, only the first. And if 4 people die together, it's only the first one we determine is the one that's going to die, is going to have the benefit paid. So it's in the textbook. I'm going to tell you right now, there will not be a quiz question. There will not be a final exam question on first to die life insurance. There is also something called second to die life insurance. As soon as I find for my little thing here. Okay. Second to die, also referred to as survivorship life insurance, says we are going to pay the death claim at the second death. There will be no death claim paid at the first death. It's typically used to provide estate liquidity, especially for federal estate tax purposes. It says it may be term or permanent. Most of the plans are permanent because people that buy these have a permanent need. It further says the cost might be greater than on a single life but lower than with 2 individual policies, which is true. So if Jack and Jill are both age 67, they're going to blend the premium. Remember, Jill at age 67 is really about Jack at age 63, so the premium might come in a little lower. They might even have a decent premium if one of them has medical problems or is uninsurable because they know they're only paying the death claim at the second death. One of the questions I'm frequently asked when I mention survivorship life or legacy life or second to die is, what happens if Jack and Jill get divorced? Well, what happens is usually they can split the policy and or pay a higher premium and keep it, or they just leave it the way it is. So the underwriting is typically less stringent than on an individual plan, and it may provide opportunities for people with questionable health, but it is going to pay a death claim at the second death, not at the first death. That's why it's called survivorship life. Now, convertible term, you want to get a term contract that is convertible to some other form of permanent life insurance, another form of permanent life insurance when Jack and or Jill want to convert without evidence of insurability. The key is without evidence of insurability. Now, this isn't rocket science. If an insurance company is giving you the benefit of convertibility and they're going to lock it in for 20 years, the premium, without you ever taking another exam, and they may even offer to renew it beyond 20 years, either at a certain premium or let you take a new examination, but it's convertible to a permanent plan of insurance at some specified date, maybe up to age 65 or 70. is going to cost more than an insurance policy that says we are going to require you to take a new exam every 5 years, or we're not going to allow you to convert it, or we're only going to allow you to convert it during the first 5 years. So the longer the benefit period that's guaranteed, the longer and the more additional benefits you have, the more expensive it's going to be. Now, I would not recommend, or for myself, I would not purchase a term contract that was not convertible. I would not purchase a term contract that didn't have transfer as much risk as possible to the insurance company. If you remember last time I spoke about the different kinds of premium between standard for about 80 to 85% of the population. If you're better than standard, you get a credit on the premium or a reduction in the premium. So some companies have standard, standard plus, preferred, preferred plus, elite preferred, super duper preferred, super duper duper preferred, and every time you get a little better, the premium goes lower. And that's all based on mortality, your life expectancy. Then there's a smoker premium. And quite frankly, a 50-year-old smoker is probably going to pay the same premium as a 62 to 64-year-old non-smoker, assuming their health, height, and weight are about the same. That shows you how much being a smoker cuts off your life expectancy. And then I mentioned that term insurance uses current mortality, so the older you get, the more expensive the premium. And I further mentioned that once you know the mortality and all that, and they figured out what classification, then the better health you're in, the higher the classification, the lower the premium. Standard is the baseline. If you're not as good as standard and you're a smoker, it's going to add money to the premium. If you're overweight, diabetic, had cancer, all of these will add extra premium dollars, and it's what's called a rated policy. So we've been online about a half hour, about 45 minutes. I'm going to close with a couple more slides on term, and then we're going to take a 5-minute break. It says, when is term appropriate? When you need a lot of insurance for a temporary period of time at a low cost. Jack's 35 years old, has 3 children. You need a lot of insurance to cover your debts and help your family. Jill is a business owner. She has a $4 million line of credit or debt. She wants to make sure, and the bank wants to make sure, that if something happens to Jill, they can pay off the loan. So, and it also says that money for premiums would be limited. So that's the appropriateness of term. Remember, term usually doesn't pay a death claim until you get much older, but people that are much older can't always afford the additional term insurance. So those are the issues here. I'm going to ask if there's any questions before we continue to move on. This is the 1-cent plan that I gave in my example last Wednesday. Let's take a 5-minute break. I'm going to reconvene at 20 minutes after the hour. That'll give everybody a little bit of a break, and then we're going to go into the next slide, which is slide number 20, and that deals with whole life insurance. So let's take a 5-minute break. Welcome back to session 2 of the 24th of February's class on life insurance, unit 7. If you remember from the previous class last week, I mentioned that life insurance, I tried to give you examples based upon using pennies per unit for life insurance, and I said that every unit of life insurance is worth about $1,000. So what I'm saying now is, even though the way I did it the other night was a little bit different, what I'm saying now is the slides show this as whole life as the next product. And for many, many years, this was the primary form of insurance people would own in the United States. And whole life insurance says we are theoretically going to pay the premium for our entire life, from age 0, 10, 20, 30, 40, all the way to age 100. Age 100 is considered full mortality, and at age 100, the policy is designed to what's called endow. Endow means that the cash accumulation in the policy is equal to the face amount. So hypothetically, if we have a $100,000 face amount or death benefit, at age 100, there would be $100,000 in cash. That's said to endow. Now, in the Vaughn book, they mention that whole life and straight life and ordinary life, there's a little bit different. But the truth of the matter is, whole life, ordinary life, and straight life in the real world means the same thing. You are paying the premium over your entire lifetime from the day you take it out until age 100. If you die before age 100 and you still have the policy in force, what's going to happen is the death benefit's going to get paid. If you want to cancel the policy before age 100 or you want to stop paying, there's going to be some opportunities to do that. That's called non-forfeiture values. Unlike the term insurance contract where the premium is using current mortality and the premium goes up so much every year or every couple years, under whole life insurance what's going to happen is the premium is amortized over your lifetime. So if you start at age 30, you're going to pay more for the premium than you would if it was 20-year term. You're going to pay less than if it was universal life because it's not amortized over your lifetime, but it is providing different structure for the insurance premium. Somebody just sent me an email. Up until approximately when was whole life insurance the primary form in the life insurance industry? From what I've been able to figure out, I would have to say probably up until about the 1960s or 70s, and then they came out with term insurance, and they've modified term insurance for many, many times over the last several years. So I would have to say to you, to the best of my knowledge, that probably since the 1970s is when term insurance really came into its own. But up until then, most people were buying whole life insurance as the primary form. I might be off a little bit, but that's pretty close. So going back, so whole life says we're going to pay the premium until age 100, but as you're going to see, there are different opportunities to pay less premium or stop paying the premium. And whole life insurance says that, and if you remember, the death benefit when paid to a named beneficiary, the death benefit when paid to a named beneficiary is income tax free. Now, if you remember the triangle I put up on the screen on Wednesday, last Wednesday, I mentioned don't get hung up on the word is never taxed, because never is not a good way to look at a test question. Always and never are usually not good answers for test questions, so be aware of the fact that if the question says the death proceeds of a life insurance contract are never taxed, it may never be taxed for income tax, but there may be legacy or estate tax, there may be gift tax, so read the question carefully. So before I move on from whole life insurance, I'm on slide 19, does anybody else have any questions they want to ask? Okay, I don't see any coming in. The 4-cent plan is a limited payment policy, sometimes referred to as life paid up at 65 or 20-pay life. And what that says is we're going to let you pay the premium over a shorter period of time. So if we're paying the premium over a shorter period of time, what does that really mean? It means we're spending more money early so we pay less money later. So all we're doing is paying more money today so we pay less money or no money in the future, and that's why it's a higher premium than whole life, but it's going to let you pay less over the whole period of time, and then the money is going to accumulate differently. And it says here the higher premiums for ordinary life because later on you don't have to pay the premium. So to the insurance company, they've figured out how much they need to collect today so you only have to pay it for 20 or 30 or 40 years. Now, quite frankly, for many years, people weren't buying life paid up at 65, but now more and more it's coming back into people saying, gee, that's not such a bad idea. Whole life says you're going to pay a higher premium early because you're going to pay nothing later on. That's what it really means. Or you're going to pay a higher premium early and less later on because you've overpaid in the early years, you underpay in the later years. When is whole life appropriate? Well, if term insurance is appropriate for people that need large amounts of death benefit for the lowest premium, whole life insurance is appropriate when you want to never have to worry about taking another physical examination. You want to make sure the policy stays in force forever. You want to make sure that you know what your premiums are so they can always be budgeted and you always know exactly what you have. And you want to make sure that you can maybe even have a forced savings program, even though life insurance is not an investment or a savings vehicle. If it's helping you put away money and accumulate cash on a tax-deferred basis, maybe that's not such a bad thing. If you remember on the slides last week, I've mentioned and discussed the fact that the premiums for life insurance, unless it becomes a modified endowment, are on a first-in, first-out basis. So the money that goes in first is the premium. The money that comes out first during your lifetime is your premium, or up to your basis of what you put in. So you defer paying taxes on that growth as long as the money's in there. And as it comes out, you don't pay tax or income tax on the growth until after you've taken out your basis. Whole life insurance will have a minimum interest rate guarantee, but it's not necessarily disclosed. It's somewhere around 3%. And it is going to then grow and compound, and the magic of compounding will work. Whole life insurance will allow you to take money out for opportunities, for emergencies, for a loan. You can collateralize the policy. Remember, the owner of the policy is the person or entity that has the right to name the beneficiary, change the beneficiary, access the cash if there is any, get the dividends if there are any, or modify the dividend structure. And those are the rights of ownership. So further be aware of the fact that whole life is a conservative guaranteed program. So if someone says to you, I want to know what I'm going to have at age 45 or 55 or 65, whole life is a very conservative approach. Some people have referred to it as an alternative to a bond fund. Now, whether that's a good example, I don't know, but you could think of it that way. I have a whole life insurance policy, I think I mentioned this last time, that I've been paying approximately $160 a year for since I was 18 years old. It has some other benefits on it, but I'm taking that money out of my left pocket, sending it to an insurance company. They're adding cash to it that's growing on a tax-deferred basis and compounding. I'm putting it in my right pocket at this point at 2 or 3 times what I've sent to the insurance company. The death benefit continues to grow and is increasing, and the cash, if I need some, will come out. Now, if I put on my hat to sell life insurance, I may want to say to you that the internal buildup grows income tax deferred, but I can use it for an emergency if I ever have an emergency. But if I take that insurance hat off and talk about what you need to know for the comprehensive exam, remember, taking money out of a life insurance contract for an emergency fund is not the best thing to do, because what may occur is you may have a negative impact on your death benefit. So for the exam, don't take the money out for the emergency fund, but if you're talking about life insurance as a vehicle, and you may want to remember that the cash in there is your money and you can take it out. And then if the money comes out of a whole life policy, it's deducted dollar for dollar from the death benefit because they assume the money's in there earning interest. Disadvantages, low rate of return. You're on the hook for the premium for life. Relatively inflexible. Once you start it is the way you get it. Advantages, you pay a premium for life, but you know what it's going to be. It's going to compound, grow income tax deferred. At some point, you can turn it into a retirement income. You can use it for an emergency fund. You can do all kinds of things with it. I have a whole life policy, as I told you, I purchased when I was 18 years old, and I actually used some of the cash when one of my children were in college because it was the easiest and cheapest way for me to get cash to help fund college, and then I just paid it back. When I say easiest, I wasn't eligible for any financial aid because of my income, and it was to do the FAFSA form was a waste of time, and I figured out that the interest on the loan, I didn't get it deferred, I had to pay it anyway, so this was cheaper. Any questions so far on whole life or limited payment life or term insurance? Now, variable life was that 2-cent plan. That's where you had flexibility, and it says this is also a permanent form of life insurance. It's going to grow income tax deferred. And the premium, this is a variable contract. Variable life, variable universal life or variable life, the premiums that grow, I'm sorry, the cash that grows is in a separate account, just like an investment account. So it's not subject to the general ledger or the general liabilities of the insurance company. It's separate and segregated for the insured or the owner of the contract. Variable life says that the owner makes an investment from a menu that looks like mutual funds. But we can't call them mutual funds because the regulators say they're not mutual funds, they're sub-accounts to the general account of the contract. You're allowed to make changes to how those investments are. Those changes can be all from aggressive growth all the way to conservative bonds or cash. The death benefit, the cash value, is not guaranteed unlike a whole life contract. The death benefit probably would be guaranteed for a minimum amount, but it's not necessarily fully guaranteed. The appropriateness is for people who have maxed out their retirement plan, are willing to take some risk, are looking for greater growth opportunities where they want things keeping pace with buying power or purchasing power. So it's for people willing to take risks. If you look at what the textbook says, willing to take risks with their investments and want to keep it inflation protected. I don't know why this isn't moving. Moving on to slide 26 if I get there. There we go. Now, in order to sell a variable contract, whether it's variable universal life or variable whole life, because there are a couple of companies that sell variable whole life, you need an insurance license for the state you're doing business in and at least a Series 6 registration, if not a Series 7. Series 6 registrations let you sell things by prospectus, and that would include whole life insurance and variable life insurance. By prospectus would be variable life and variable universal life and variable annuities. So those would be the licenses you would need, or the registrations. So then we talk about universal life, which was the 2-cent plan I mentioned last week. If I'm going too fast, somebody send me a message and let me know. The universal life contract says this is a permanent form of insurance, just like the variable universal life or the whole life or the limited payment life. We only need to take one examination, and once we take the examination, we never have to retake one as long as we pay the premiums and keep the policy in force. Universal life says The cash and the death benefit can be increased or decreased just like any kind of permanent insurance based upon how much we put in. The universal life contract is called unbundled because you're going to see how much cash is in the account. You're going to see what the expenses are. You're going to see what the interest rate is that's projected. You're going to have options for either a level death benefit or an increasing death benefit that's Plan A or Plan B. So depending on how you design the contract, the death benefit could increase based upon the amount of cash in it. You're going to be able to see the different premium structures, which could be the minimum premium that's like a term contract, the target premium that's designed to keep the policy in force to age, hypothetically 60, 65, 70, age 100, age 120, based upon the minimum death benefit or the maximum premium, which is so it doesn't become a modified endowment or an investment, according to the IRS. Universal life uses current mortality costs. So the older we get, the more money we need to maintain the cost of the pure death benefit. The shortfalls of universal life. Well, if you don't have enough cash in the policy and you're paying a minimum death benefit, your policy may lapse based upon that premium. So if the minimum premium is $1,000 a year, and now you're 70 years of age, and you've been paying the same $1,000 per year since you were 35, you may not have put in enough premium at the minimum interest rate because the projection may have been a 9% interest rate. So you have to be very careful what you do and monitor it. And most people and most agents didn't understand how they had to monitor it when it was designed in the 1970s. They just assumed everything was going to stay the same as a whole life contract, and they were surprised. In this example, it says we paid $1,000, we have $600 in cash, so we have a total of $1,600 to pay the premium. However, our current mortality charge is $2,000, so if we want to keep this policy in force, we need to add to the amount of premium because we were paying a lower premium than we should have. It says that a universal life policy is flexible. It says the flexibility nature of the universal life contract permits partial withdrawals and they're not treated as loans, where partial withdrawals from a whole life contract are treated as, will be treated as a loan. So a whole life contract, if you take money out early, it's considered a loan, and as a loan, it subtracts from the death benefit. A partial withdrawal from a universal life contract might not be treated as a loan. It depends on how it's structured, and it might just be that the death benefit stays the same, but the cash goes down. And in many cases, the universal life or the contract will say that if our minimum interest rate is 3%, and we're currently crediting you 5%, and you go to borrow money from the contract, the interest on that loan will be 5%, and we'll maintain the interest at what the crediting level is. So that's a big advantage. On a whole life contract, in most cases today, the interest that you're being charged for the loan is somewhere around 5 to 6 or 7%. Loans from a life insurance contract, whether it's whole life or universal life, need not be repaid because as long as the death benefit is paid and there's at least $1 of death benefit, that loan becomes forgiven. It's just subtracted or adjusted from the death benefit. You can read more about that in the textbook. If you do have questions about it, make sure I know about them and I will cover it in more detail Wednesday. I'm going to take a 1-second break because I want to check something. So we're going to be talking about the 2 different kinds of designs. Just give me 1 second. I'm not turning off the microphone. Thank you very much. I appreciate you giving me a second there. Universal life, unlike whole life, unlike term insurance, you can design the contract, the policy itself, for either a level death benefit that's called option A or an increasing death benefit that's called option B. And it says that the level death benefit, if you're trying to design a policy to generate more savings or cash, use a level death benefit because that's going to permit you the opportunity to let the cash grow because you have a lower amount of mortality charges because you have a lower death benefit. The increasing death option is going to say we're going to take additional mortality, additional cost as the cash increases in the contract. And if you remember Wednesday, I showed you how that would increase using just a simple box. And so if the cash goes up by 10,000 or 20 or 30,000 over a couple years, the death benefit's going to increase by that amount. So in effect, you're getting the death benefit of your death benefit plus all the cash that's built up. Again, I refer to the Vaughan book for more information. I'm moving over to slide number 31. The example here is Takora is covered for $200,000 under a level death benefit option A universal life contract. It has $50,000 of cash, but under a level death benefit option, the $200,000 death benefit stays the same. The fact that you have $50,000 in cash doesn't mean anything, and if you die, all you have is $200,000 of death benefit. In a whole life contract, unless you have a certain dividend structure, you still have only $200,000 worth of death benefit. If, on the other hand, you have an increasing death benefit, let's look at this next slide, number 31. Mike is covered under $200,000 under option B. He has $50,000 of cash. His new death benefit is now $250,000. Now, the reason I'm saying each plan has its own advantage, if your goal was to generate as much extra cash for retirement as possible, leaving a level death benefit was probably better because you're going to have more cash accumulation. If, on the other hand, you wanted your cake and eat it too, so that you wanted to have the ability to have the growth of the death benefit as well as the growth of the cash, if you needed it, that's option B. You're not as concerned about the maximum growth for retirement as much as the maximum growth for death with something fair for retirement. Now, this was the 2-cent plan. So just to review, the 1-cent plan by my example is term insurance, meaning 1 cent per unit, and it was term insurance, the cheapest way to get insurance per unit. The 2-cent plan is the universal life insurance contract that's interest sensitive, not the investment type, but interest sensitive. The 3-cent plan was the whole life insurance. The 4-cent plan was the limited payment life insurance contract. The 5-cent plan is no longer being sold because the tax laws changed. That's the endowment insurance plan, where the cash increases at a much faster rate, and the cash will be worth the same as the face amount of the death benefit on a specified date and time. When we're speaking further about life insurance, the investment vehicle, the universal life or variable universal life, says we're going to let the cash grow at some factor later on based upon the value of the underlying accounts, which are investment vehicles. So that's the 1 cent, 2 cent, 3 cent, 4 cent, 5 cent, plus the universal life. The variable universal life I've already discussed. It's similar to the universal life, except the cash grows based upon how the investments work. The endowment policy is that 5-cent plan. It's no longer sold because of a change in the tax law. And what happens with endowment contracts is if you take the money out during your lifetime, the cash out during your lifetime to use for a loan or retirement income, what happens is it's taxed at ordinary income tax rates on a LIFO LIFO, last in, first out basis, unlike a FIFO, first in, first out basis. So what I'd like you to do before Wednesday is write down LIFO and FIFO so we can have a little discussion about what that really means if you take the money out during your lifetime. There's a huge difference in how it's taxed. I also want you to spend a few moments and look up modified endowment. We'll discuss that a little bit on Wednesday and definitely next Monday. Modified endowment contracts, you have to understand what those are. It's very important because in a couple previous exams ago, the modified endowments were, there were 5 questions on the exam, the comprehensive exam on modified endowments and how the modified endowment was taxed during your lifetime if you took cash out and or at death. Slide number 35. Adjustable life. Adjustable life permits the owner to increase or decrease the coverage and the premium as well as to adjust the amount of term versus whole life. It typically is a rider and it lets you adjust things without proof of insurability. I'm going to tell you, I don't believe there's going to be any test questions on it. There will not be a quiz question or a final exam question on it. But why is it on the slide? Because it's in the textbook and it might be on the comprehensive. Slide 36. Life insurance is a contract. I'm sorry, slide 35. Life insurance is a contract between you, the owner, and or the insured, and the insurance company. It is not a contract between the agent and the owner. It's a contract between the insurance company and the owner. And it further says that depending on the contract, it has different provisions. In a whole life contract, there's something called an automatic premium loan. In most permanent plans, and even term, there's a grace period. There's an incontestability clause. There's a reinstatement clause. There's a suicide clause. There's a misnomer that if somebody commits suicide, the insurance company is never going to pay that claim. The truth is the insurance company will pay a claim if somebody commits suicide, and I'm going to explain how. It's not always a no claim. There's a misstatement of age clause. In the contract itself, it's going to tell you how they're going to pay the claims. What are the options? What are the settlement options? Who's responsible for what? It's all part of the contract. And if you have a life insurance contract, I would strongly urge you to go look at it and read it and see what the exclusions are. You're going to find that the exclusions are usually intentionally inflicted injuries during the first 2 years, acts of war and or probably nuclear explosions, acts of war. If you remember, on 9/11, the President of the United States said, we were attacked by evildoers, and those people will be brought to justice, but we were attacked, and this was an act of war. There are exclusions in the contracts that say we, the insurance companies, don't have to pay for an act of war. So the insurance companies came out and said almost immediately, we're going to pay the claims, even though it was classified as an act of war. So let's break down these different items here so you understand them in a little more detail. The grace period. The textbook refers to the grace period as that period of time after the premium is due, where the death benefit will still be paid and you have an opportunity to pay the premium. It's the float. It's the same thing you have with a credit card, except here it says it is usually or can be 31 days. Some states say it's 1 month. Some states say it's going to be 30 days. I don't care what it says. It's going to be, depending on the state you're in, determines if the grace period is 31 days, 1 month, or 30 days, but just assume it's 30 days. And it says that if the insurance policy, if you die during that 30-day period, the policy is deemed to be enforced because they're making the assumption that you will have paid the premium. That's what the grace period is. It's trying to help you keep the policy in force, and the grace period itself, ladies and gentlemen, is the same whether it's a term contract or a whole life contract. It doesn't matter. Grace period is the grace period. In some cases, if you have a whole life contract, in addition to the grace period, you have a thing called the automatic premium loan, or APL. The automatic premium loan says if there's any cash in the contract, we, the insurance company, are going to use that cash to keep the policy in force. And if necessary, we would borrow money from the policy itself to keep it in force. Usually you have to check a box on the application, and quite frankly, anytime I've ever sold a whole life policy, I don't sell a lot of them any longer, but anytime I've ever sold a whole life policy, I always check the box, because you don't know what's going to happen. People forget. They go on vacations, and this is just another way to help use that cash to keep the policy in force. If it's not elected, then what might happen is non-forfeiture values could automatically come into being, and I'm going to explain those in a few moments. What does it mean to be incontestable? Incontestable means we can no longer challenge the insurance company. The insurance company can no longer challenge us to see if we made a mistake or they made a mistake. The incontestability period is typically 2 years plus 1 day, because it says after 2 years of the policy being in force, which means after all of the underwriting and all of the signatures are granted and given and approved. So if there's any changes to the contract, it has to be done in writing. The delivery receipt has to be, I'll answer your question in a second. The delivery receipt has to be signed off on, and any change to the contract. Once that happens, the policy is deemed to be in force. If the insurance company made a mistake during the underwriting process, they could make a mistake. Maybe they put you down for the wrong classification. Maybe they didn't get all the information, or maybe they found out that you made an honest mistake and your date of birth, you made an honest mistake and something was incorrect. Not a fraud, just a mistake. They have 2 years, 1 day to find out that they made the mistake. Otherwise, they have to honor the contract. So the law says you're given a specified period of time to see if you made a mistake. Otherwise, live with it. It says the insurer may contest the policy with no time limit if there's no insurable interest when the policy was issued. Or if someone had the intent to murder the insured. Or if someone was perpetrating a fraud. They put down that they were HIV negative or they weren't a smoker, and that's perpetrating a fraud, then there is no incontestability period. But typically, the incontestability period says you have 2 years plus 1 day, because the law says if within 2 years. Now, the question just came up, why aren't I selling a lot of whole life policies anymore? Mainly because I'm not selling a lot of insurance anymore. But the other reason is, for many years, people didn't, a lot of companies weren't selling whole life, they were selling more universal life or term insurance. But that's why I said I'm not selling a lot anymore. I happen to believe in whole life insurance. I own it myself for the right person in the right situation. And why has this taken place? Because, number one, in many cases, term insurance became much cheaper. So people would say, well, as opposed to spending $1,000 in premium, I can spend $400 in premium. If I die, I have the death benefit. That's all I care about. Or as opposed to spending $1,000 in premium for whole life insurance, I can spend $600 a year for the universal life with a minimum premium, and I'm happy. I'm not going to generate as much cash, but I'm not spending as much money. So that's the primary reasons. I happen to believe that whole or permanent life insurance is something most people should have in their portfolio, and here's why. Many times when people leave their job, they retire or they get downsized, the average person has most of their insurance in the through their job. So when they retire, what happens is they lose their death benefit. Now, they might have the opportunity to convert it, but they're converting it at a higher premium. And the way those death benefits as part of the group plan are set up is they're not set up at the super duper preferred standard. Sometimes it's standard plus an extra fee because the people that convert it usually aren't in the best of health. And if you take underwriting and are able to pass the exam, you usually can get a better premium. So there's pluses and minuses. I'm working on a financial plan right now with somebody who knows he's going to lose his job in 2015. Why? Because his company is closing down an entire division, and they used to have several thousand employees. Now they're down to the last 500, and he's one of the people that's going to be there to help shut the whole thing down. He happens to be diabetic, so he was told that he's not going to be able to keep his life insurance unless he converts it. And now we're trying to figure out if he's better off converting it to his own plan if we can get it for him versus the other plan. Please remember that when the company goes out of business, COBRA for health insurance doesn't exist anymore because there's no underlying plan. Okay, I'm going to take another 5-minute break and then come back and do the last group of slides for tonight because I've been trying to keep this to about a 45-minute situation. So with your permission, I'm going to reconvene at like 2 minutes after the hour. Please give me a check mark when you're in the classroom, but let's take a 5-minute break. This is session 3 on Monday, the 24th of February. Oh, by the way, thank you for the couple of congratulations just came over. Life insurance companies want to let policies stay in force. And what they have set up is what's called a reinstatement provision, which means after the grace period, if you still have money that's owed, you haven't paid the premium, they're going to let you reinstate the policy providing that you reprove evidence of insurability, pay back all back premiums plus interest, which means you may have to take a new medical exam, which also means if you had a negative impact on your health insurance. When you bought the policy at age 30, you were in perfect health, super duper preferred, and everybody was happy. Now you're 48 or 50 and you're diabetic and you're overweight, you're going to have a hard time proving insurability at the same premium if you can get it. It says in the textbook that typically reinstatement, the insurance companies let you reinstate it for 2 to 3 years. I know insurance companies that won't allow you to reinstate it for more than 6 months because they just won't let you do it. So read the company rules carefully. Reinstatement is a great provision that helps you keep the policy in force. So these are, again, we have the grace period, which is the period of time where 30 days or 31 days to let you pay the premium. Whole life allows for automatic premium loan to keep the policy in force. Reinstatement says that after that period of time, we'll let you do it with evidence of insurability. And quite frankly, some insurance companies say your premium is due on such and such a day. You have 30 days, and sometimes they'll even give you an additional 10 or 12 or 15 days. They're going to do everything they can to keep the policy in force. The incontestability clause period says 2 years plus 1 day, and unless there's fraud, we're going to have to live with any mistakes we made. The purpose of reinstatement is to help you keep the policy in force at the original age of your premium. So here it says that it was started at age 30. Well, obviously, the premium at age 30 is going to be substantially lower than the premium at age 44. There's a situation that says, slide number, whatever, 40-something, that if you have a misstatement of age, in other words, there was a long period of time in the 1700s and 1800s and early 1900s, and especially with people that came here as immigrants, they didn't know the exact day or year they were born. So if there was a misstatement of age, it's not considered fraud. They're just going to adjust the death benefit to what the current age is once they can prove it. For many years, and this is giving some history to some of you, women would never admit to being younger than the men they were married to. It was considered wrong. In fact, I Love Lucy, Lucille Ball, who married Desi Arnaz of the I Love Lucy TV show, he was like 6 or 7 years younger, and she was the first major star or personality that came out and said, I married a younger man and there's nothing wrong with it. And up until then, women would never admit it. I had a client who would never admit what her age was, and the joke was when she passed away, her family said, should we or should we not put her actual age on her headstone? Because she never wanted anyone to know her real age, and part of the reason she didn't was she was 2 years older than her husband. No, she died at the age of 97, but she didn't want people to know her age. So if this is a misstatement of age, it's not considered a fraud. They just adjust it. On the other hand, what is a fraud? Jack is a smoker. He says he's a non-smoker and goes and signs up as a non-smoker, and the insurance company finds out after the policy has been issued that he was a smoker. Why would they find out after? Maybe he applied below the level of underwriting that would be required for a medical exam. Maybe the medical exam at his age said, you need a medical exam at the age of, or for $150,000, he applied for $125,000. So they would just take what's on the piece of paper if they didn't find out he was a smoker until, well, let's look at it. He dies of lung cancer 3 years after the policy is issued. Well, is it incontestable or is it fraud? Well, maybe they can go back and check the medical records and find out that he knew he had lung cancer 4 years earlier. Then it's fraud. If he didn't know, or a reasonably prudent person wouldn't have known, then it may not have been fraud. So again, pay attention to the examination. Just worry about the incontestability period being 2 years plus 1 day. And that misstatement of age or even sex doesn't really matter unless you're trying to perpetrate a fraud. But if it is definitely a situation where they can prove fraud, the incontestability period doesn't matter. But for the exam, I don't think you're going to have that question. Now, let's talk about what this suicide clause means. People believe, and I'm on slide 42, people believe that if you commit suicide, the insurance companies are never going to pay. But the insurance companies realize that most people that commit suicide haven't planned it 2 or 3 years in advance. Most people that commit suicide, it's an impulse situation. It's a permanent solution to some kind of problem. They can't handle the stress. They can't handle it. So they will kill themselves. But the insurance company says if you bought an insurance policy on, say, January 5th, 2010, and you committed suicide January 2nd, 2014, you wouldn't have bought that policy with the intent of waiting that long to commit suicide, so we're going to pay the death claim. If, on the other hand, you bought the policy on September 1st, 2013, and on January 2nd, 2014, you killed yourself, then there may have been an anticipation of doing it in death. They're not going to pay for suicide. So the suicide clause is usually the same as that incontestability period of 2 years plus 1 day. And the insurance companies have found out that most people who are planning suicide will not wait 2 years and a day. So be aware that on slide 43 or the 42, that's what we're referring to. There are other riders on an insurance contract. A rider. That's something in addition to the general contract that's either called a rider or an endorsement, and you pay an extra premium for it. One is called waiver of premium. Another is future purchase or guaranteed insurability option. A third would be called accidental death. Now let's discuss waiver of premium because it means a different thing for a different policy. Disability waiver of premium for whole life says, if you're sick or disabled and can't work, we, the insurance company, are going to refund all the premiums you paid after 6 months of your disability. We, the insurance company, will continue to make all future premium payments for you. We, the insurance company, will honor all the contractual provisions just as though you made the premium payments. Should you get better and go back to work, you never have to pay us back. However, if you don't get better and go back to work, we will honor every commitment and every provision of the contract. In a whole life contract, all the cash that would have accumulated anyways. In a term contract, for the period of the term, we will keep it in force, and you don't pay the premiums. Now, that's in the contract if you have this rider. I would say 30 to 40% of the people buy the policies with the rider, and the balance of the people don't. Sometimes in term insurance, a lot of people don't because it adds to the cost and they don't want to spend the other money. But if you think about the advantage on a whole life contract, if you become sick or disabled and can't work, it's fully paid up. If you have a whole life contract, the reason you buy it is for the cash accumulation. So if it's fully paid up, that's a good deal, and you don't have to make the premium payments. Let's talk about this for a minute. If you have a bank account and you're putting in $100 a month into the bank account, and after 27 months you become disabled and can't work, so you can't put the $100 a month in, you have $2,700 plus the interest. If you have waiver of premium on a whole life contract and you're putting in $100 a month, and let's say you're 30 years old, you probably have a $20 or $25 or $50,000 whole life contract. That whole life contract, then you're making the premium payments. If you became disabled and couldn't work, what happens? The insurance company makes them for you. So they become a little better than your bank for the purpose of that. That's disability waiver, and it's really a very valuable benefit. If you have universal, if you have a universal life contract, I get to the right slide, sorry. Universal life, there are two kinds of waiver of premium. One is waiver of premium of the mortality charge. In other words, we'll keep the policy in force as a death benefit. The other is a full disability where we're going to add to the cash. Obviously, the full disability is going to cost more. So waiver of premium, depending on the kind of insurance policy, has a different structure. For term insurance, it'll keep the policy in force the way it is. For whole life, it'll keep the policy in force and continue to build the cash. For universal life, depending on the kind of waiver premium you have, it's either partial, full, or mortality only. Slide number 46. Future purchase or guaranteed insurability option says, when you're healthy and you bought your policy, especially whole life insurance, we, the insurance company, are going to guarantee that you are going to be able to buy more life insurance at a future time, even if your health changes. So that if you're in perfectly good health at the age of 25 and something's wrong at the age of 35, because that's one of the ages that's on your contract, it's usually every 3 years starting at age 21, or when you get married, and sometimes when you have children, anywhere from 7 to 10 times the original face amount. We will permit you to buy more life insurance on your signature, even if your health changes, and even if you're on a deathbed. So guaranteed purchase or future insurability says, even if your health changes, we're going to let you buy it at the original premium classification you were in, or at the current age. I've had clients who have had massive heart attacks in their early 30s and have purchased an additional 2 or 3 or 4 times more life insurance just on their signature at the preferred or standard rate that they would not have been able to get without it. Now, if you have waiver of premium on your policy and waiver of premium on the future purchase option, just so you know, it automatically converts for you as long as you sign the paper. So That's a very valuable benefit. The other benefit that they talk about, I'm not as much a believer in, is accidental death. And if you remember, we spoke about it last week. Accidental death says, if you die in an accident, we're going to double the death benefit. So my question is, do you need $250,000 of death benefit for your family to protect them properly, or $500,000 of death benefit? If you need $500,000, the difference between 24-hour protection, either using term insurance and temporary protection in the event you're in an accident, the premium difference might even be cheaper. So I don't believe in accidental death, and I normally don't ever recommend it, and I've had people take it off their policy. The first insurance policy I purchased had accidental death on it. When I knew more, I had to take it off and save the premium dollars and then bought 24-hour protection with term insurance. Now, insurance policies that are participating insurance policies, especially participating whole life or limited payment life, pay a dividend. This is not a dividend like a stock dividend. This is a dividend which is return of excess premium that the insurance company didn't need in order to pay the death claim. In effect, the actuaries are very smart. They figured out what you needed in order to make sure that they charge the right amount of money, and if they don't need it, they didn't charge for it. They actually overcharged for it so they could give you back some of your own money. Most dividends are income tax free unless they're modified endowments, and we'll talk about modified endowments in Unit 8. There are 5 dividend options. 5 dividend options. You can look at them in the bond book. Some insurance companies will list the first 4 in different orders, but the 5th dividend option always stays number 5. Cash. Cash. The insurance company is going to return some cash to you as a dividend option. Now, reduce the premium, in effect, does the same thing. Your premium is $200, your dividend is $10. They're going to reduce the premium and only bill you the difference. Accumulated interest. Accumulated interest says, we're going to turn this into a savings account. Just like any other savings account, we're going to let the money accumulate and grow in the policy. Number 4, buy additional paid-up life insurance. At younger ages, this helps the life insurance policy grow more. When I was 18 years old, I bought a life insurance contract. It had waiver of premium, future purchase option, accidental death and dismemberment, double indemnity, and buying more life insurance. The dividends were used to buy more life insurance, so my death benefit today is somewhere on a $10,000 policy is somewhere around $28,000. $28,000. I had exercised the waiver or the future purchase option a couple times, so I was able to buy an additional policy. I didn't exercise it every time I needed it because I went and bought a larger policy at some point and it was more cost effective. I got rid of the accidental death and dismemberment because it was costing me like, I don't know, $12 or $20 a year, and I just used it and bought that for some extra term insurance and saved some money. The 5th dividend option says, just like the increasing death benefit on a universal life contract, option B, we're going to buy 1-year term insurance equal to the cash in the account. So in that case, we're getting more death benefit for the cash. Now, sometimes that's a good idea, sometimes it's not. But that's what the 5th dividend option is. And it's always 1-year term insurance equal to the cash value. So pay attention. The 4 other dividend options would be cash, reduce the premium, accumulated interest like a savings account, or buy additional paid-up insurance. The dividend options themselves are non-taxable events, but there's a catch. If you are using the dividend option to accumulated interest like a savings account, what happens if you earn more than $10 in interest at a bank in a savings account, they're going to send you a 1099. So if you have a accumulated interest, it's going to generate more cash than the buying additional insurance, but then you're going to have to pay income tax on that extra growth. You're not paying income tax on the dividend, you're paying income tax on the savings account value, just like you would at the bank. I hope everybody understands that. Non-forfeiture options are, again, in the textbook, and there's a chart that you can look at that says what it means. And non-forfeiture options say that you want to stop paying the premium. You have a whole life policy or a limited payment life policy, and you have certain things that have built up in that contract so you don't have to pay the premium after a certain point in time. And what does it say? Number one, you can get cash. So they will take the number of insurance units you have, multiply it by the amount of cash at any given year, and that'll determine how much cash you can get if you want to cancel, stop paying the premium. The second option would be get a reduced paid-up policy. Take the number of insurance units you have times the dollars of insurance you've paid for, and you have a reduced paid-up policy. The third option is to keep the face amount the same, or the death benefit the same, and then do what? Turn it into term insurance. So let me go to the next slide, and what does it say? This shows that in policy years 1, 2, 3, 4, 5, 10, 20, and age 65, this is hypothetical, you have $50,000 of face amount or death benefit. Let's look at the 5th year. It says you have $47 of cash. I just picked out numbers for an example. So here it says you have $47 of cash per thousand. So for every $1,000 you have $47 of cash, multiply it by 50, or multiply 470 by 5, and that's how much cash you can have if you want to walk away with cash. Depending on the basis, you may have some income tax due. The next item says reduced paid-up insurance. So you have $136 per thousand of insurance, multiply 136 times 50, and that will tell you how much death benefit you paid for. In the 5th year, you want to turn this into a term contract. That $47 per thousand will buy term insurance for $50,000 at your age for 15 years, 145 days. This is right out of your textbook, and be aware you might get a question like this on the exam. So what I'd like you to do on your own is say, go to the chart before and just figure out in the 5th year or the 10th year, assuming it's $75,000, what is the amount of cash you'd have, what is the amount of reduced paid up, and what is the amount of term insurance for the number of days and years and days. And just pick any one of the numbers on the previous chart. And that's an assignment you can do, and you should do it because on my comprehensive exam, that is what I had a chart like that for $75,000. The impact of the automatic premium loan on the non-forfeiture value is it obviously might reduce the amount of cash you have. Some people think that's horrible. I don't think it's so horrible. It keeps the insurance in force. When you die, 90+% of the people will take the death benefit in cash. 90+% of the people will take the death benefit in cash, a lump sum payment. Sometimes you're going to take the death benefit, either just the interest, and the death benefit is income tax free, but if you take out any other system, you might have to pay income tax on the interest earned. So it says here, the insurance company is going to keep the proceeds, pay somebody the interest, and then later on, the proceeds are paid, either to the current beneficiary or the next beneficiary. Sometimes it's going to say the fixed amount until you're going to pay a fixed amount over installments until you spend all the money. Sometimes you're going to pay it over 10 years, 15 years, or 20 years. These are all different kinds of settlement options, and we're going to discuss the settlement options when we talk about annuity options next week because they're very similar. when you look at the annuity options or the settlement options for a life insurance contract, if the insurance company is paying it over one life, paying the money over one life, and you're going to get the most money. If they're paying it over 2 lives, they're going to have to split it out over 2 lives, you're going to get a little less money. If they're paying it over 5 years, or let's put it this way, if they're paying it over an annuitization of life only, you're going to get the most money under an annuity, but they're under a life insurance contract, they're obligated to pay the money either in cash or over a lifetime or over a period certain. Now, I promise you, you're going to understand this more when we talk about annuities, but here's what you should be aware of. The insurance company is obligated to pay the death benefit either in cash as a lump sum, or over somebody's lifetime, or over a guaranteed period of time, and or lifetime. The longer they're going to guarantee to pay the proceeds, the less money you're going to get every single month, but you're still going to end up with approximately the amount of money you should have had to begin with. Possible test question. Under the National Association of Insurance Commissioners, which we spoke about earlier as an association of commissioners, which has no legal standing but does come up with model legislation, the policy illustration says, what must we disclose to people so they can make an educated guess or an educated inquiry about what they want to buy? And it says, the preliminary illustration says, here's what we are proposing. What is your premium classification? Are you preferred or standard or not standard? What is the assumed interest rate? If it's whole life, what is, they're just going to say what the interest rate is assumed to be, or what it is. If it's universal life, they're going to show what is the minimum interest rate that they can pay versus the current interest rate. What is the way we're going to pay the premium, monthly, quarterly, annually? What other benefits, waiver of premium, future purchase option, what we have to follow. All of this information has to be in the illustration, and the insured, owner, and the agent all have to sign off on it. Any changes when the policy is issued, all of those changes also have to be modified and signed off on, so you have an accurate illustration model. The National Association of Insurance Commissioners has proposed model legislation to protect the public. And that's where they have the advertising rules, the illustration rules, and so forth. And they will also say what we need to do in order to have the insurance companies accredited. And there are 12 ratios that are in your textbook. The ratios that are in the textbook are on financial situations to see how strong the insurance companies are. If the company is out of kilter on 4 of those 12, it goes into what's called the watch list, and many times companies that are AAA or A+, once they go on the watch list, frequently go down and or go into rehabilitation. The NAIC has no legal bearing, no enforcement power. It's an association that helps promote model legislation to the different states. On the labeling of the illustration, this is information that has to be shown: the age, the sex, the name of the insured, the name of the owner, the initial death benefit, who is the producer, and again, the insured, the owner, and the producer all have to sign it, and also have to sign any changes in order for the policy to be fully enforced. The regulation also says that the figures have to be certifiable, which means the insurance companies have had to provide them and have them approved. It says who has to sign it. It cannot represent anything. You can't say this is an investment or this is an insurance contract. It has to say it's an insurance contract. It can't be called a retirement plan. It can't say the premium will vanish after so many years. It has to be very, very specific about what it's going to be. I'm going to go a couple more slides before I finish up. A decision to replace life insurance is a very important decision, and you better pay attention as a financial planner and as a producer, because if you advise someone to replace their insurance and they cancel the policy they currently have before they've got the new one in force, you may have just messed them up, because if their health changed, they may not be able to get the best premium. Remember last time we talked about twisting as an inappropriate sales practice that's illegal, which says we're helping us more than we're helping the client. I think I'm going to stop here on slide number 61 and go back next time and talk about advanced death directives and accelerated death benefit riders and so forth. And then, so next Wednesday, what we're going to do is we're going to start with the midterm. If you have any questions, I'm going to answer them then. A couple people have sent in questions. I really don't feel comfortable answering them until everyone's turned in the midterm. As of before class, 3 people have turned it in. So we're going to start with the midterm. You will see what your grades are, and then I'll answer any questions. If you don't have access to a microphone, email the questions in advance so I can be aware of them, or when you get here, go into the chat room. We're then going to go back and finish the slides for Unit 7, and then if we have time, I'm going to do a little 15 or 20-minute primer on Social Security. Even though it's not on the syllabus, it's something you should be aware of. Next Monday, we're going to do Unit 8, and then we're going to still get you done on time. Are there any questions? And I'd like some feedback, either with some emails or whatever, to find out what your thoughts are about if you thought that the explanation last week helped you fully better understand life insurance and how you think this is going. So feel free to send me an email on that. I'm going to stay in the classroom until everybody's left in case anyone wants to talk to me offline. I'm going to stop the recording, and if anybody has questions, let me know. Thank you very much, and I will see you. Hopefully, I'll be here 5 o'clock on Wednesday.